Investment strategies for building long-term wealth. Are you tired of living paycheck to paycheck? Do you dream of building long-term wealth and financial security for yourself and your family? Investing can be a powerful tool in achieving these goals. But with so many different investment strategies out there, it can be overwhelming to know where to start. In this blog post, we will explore some tried and true investment strategies for building long-term wealth that anyone can implement, regardless of their income or experience level. So grab a cup of coffee and get ready to take control of your financial future. Asset allocation. Building wealth over the long term requires a well-thought-out investment strategy. Here are some tips for building a portfolio that will grow your money over time. 1. Begin with an asset allocation that is right for you. A common mistake people make when investing is trying to do too much at once. Instead, start with a simple asset allocation and adjust as needed. 2. Don't put all your eggs in one basket. Diversity is key to preserving wealth over time. In addition to stocks, bonds, and real estate, consider diversifying into commodities, mutual funds, and precious metals. 3. Stay disciplined with your investments. If you're not careful, you could end up losing all of your money if the market goes south or if you take on too much risk. Stick to a predefined budget and invest only the amount of money that's affordable for you. 4. Review your portfolio regularly to see how it's performing and make changes as needed. Keeping an eye on your holdings will help ensure that they're positioned correctly for long-term growth. Diversification. In order to build long-term wealth, investors should diversify their portfolios. This means investing in a variety of different types of assets, including stocks, bonds, and real estate. Each type of asset has its own set of benefits and drawbacks. For example, stocks offer the potential for quick returns, but they also involve risk. Bonds provide stability and low-risk returns, but they are typically not as volatile as stocks. Real estate can provide both immediate and long-term benefits, such as increased investment value and tax deductions. Each investor should carefully consider which type of asset is best suited for their individual circumstances and goals. By diversifying their portfolio across a variety of different types of assets, investors can create a foundation that will support their financial security over the long term. Risk management. Many individuals want to build long-term wealth, but they do not know how to do it. In this article, we will discuss some investment strategies that can help you achieve your goal. One important thing to keep in mind when investing is to diversify your holdings. This means owning different types of assets so that if one type of asset falls in value, your overall portfolio remains stable. Additionally, invest in low-risk securities such as government bonds and CDs. These investments offer stability and modest returns while protecting your principal investment. Another key principle is don't put all of your eggs in one basket. Try to spread out your investments across a variety of markets and sectors so that you are not too heavily invested in any one area and risk losing money if the market falls. Finally, remember to stay disciplined with your finances. Don't overspend or borrow too much money without planning for future expenses, otherwise, you could end up financially disastrous. By following these guidelines, you can ensure that you are building long-term wealth rather than short-term gain. Financial planning for retirement. When it comes to retirement planning, many people focus on the short-term aspects, such as how much money they will have saved at the end of each year. But if you're not also thinking about how you'll generate income during your retirement years, you may be putting yourself in a precarious financial position. Here are 4 important things to consider when planning for your retirement. 1. What kind of lifestyle will you want to maintain? 2. How will you finance your current expenses? 3. How much money can you realistically expect to receive from Social Security and other sources of pension income? And 4. What investments should you make to provide long-term stability and growth? There's no one answer that fits everyone, but by considering all these factors, you can build a solid financial foundation for your retirement years. Understanding your investment objectives. When you're thinking about your investment objectives, it's important to consider how you want your money to grow over time. There are a few different ways to achieve this goal. 1. Grow the value of your investments. Invest in stocks that are in the midst of positive growth and hold on for the long haul. 2. Diversify your portfolio. Be sure to have a mix of asset types, including stocks, bonds, real estate, and commodities such as gold and silver. This way, you're less likely to be affected by any one sector or market crash. 3. Minimize fees and taxes. Avoid high-cost investments that will cost you in terms of commissions and penalties. Look for Vanguard mutual funds or exchange-traded funds (ETFs) that have low expenses. 4. Follow a long-term investing strategy. Make sure your plan is designed to span at least 5 years or longer, otherwise, you may end up taking too much risk with your money. Determining your investment period. The most important factor in determining your investment period is the length of time you need to achieve your financial goals. This can vary based on your individual situation and the amount of money you are investing. If you have a short-term goal, such as saving for a vacation or retirement, then investing in shorter-term options, such as mutual funds or exchange-traded funds (ETFs), may be appropriate. If your goal is more long-term, such as saving for a down payment on a house or starting a business, then investing in longer-term options, such as bonds or real estate investment trusts, REITs, may be better suited. Once you have determined your investment timeframe, consider how much risk you want to take on. Some investments offer higher returns with greater risks than others. For example, stock market investments tend to offer higher returns but also greater risk of losing money. Bond investments offer lower returns but also lower risk of losing money if the bond falls in value. It's important to choose an investment that fits your risk tolerance and long-term financial goals. Choosing the right investments for you. There are a number of factors to consider when choosing an investment strategy for your long-term financial well-being. To begin with, you need to decide what kind of return you expect on your money. Some common options are high-yield stocks, bond funds, real estate, investment trusts, and dividend stocks. Once you know what you're looking for, you need to figure out how much risk you're willing to take. This will involve considering the volatility of the markets and calculating how much money you'll lose if the investments go down in value. Finally, it's important to make sure that your chosen investments fit within your overall financial goals. For example, if you want to save for a down payment on a home or retire early, investing in stable assets like government bonds may not be the best option. By taking these steps and consulting with a financial advisor, you can build a solid foundation for long-term wealth growth.